Most people think debt is what you use when you're broke, and wealth is what you have when you don't need loans. The reality is that wealthy people often borrow on purpose, even when they could pay cash. Here's the punchy scenario. You have $10 million in stock, and you want $500,000 for a house, a business, or just a big life expense. Do you sell part of the stock, or do you borrow against it? The twist is that selling can create a tax bill right now, while borrowing can avoid that tax for the moment. The main idea is simple. The rich borrow because it can turn paper wealth into spendable cash without triggering taxes and without giving up the asset's future growth. Think of borrowing as renting money, and think of selling as giving away a slice of your future. Most people use debt defensively, like a credit card for groceries or a loan to survive an emergency. Wealthy people try to use debt offensively, as a tool to keep assets intact while still living off the value. That difference changes how the math feels and how the risks show up. Let's define the tool in everyday terms. An asset-backed loan is a loan where the bank looks at something you own and says, "We'll lend you cash because we can take this if you don't pay." If the asset is stocks, it might be called a securities-backed line of credit. If it's your house, it's home equity or a HELOC. The important part is that you're not selling the asset, you're using it as collateral, like a pawn shop but with cleaner terms and a lot more paperwork. You still own the thing, but the lender has a claim if you break the deal. Now, the running example. You own $10 million in stock that grows around 7% a year on average. Just as an illustration, you need $500,000 in cash. Option 1, sell $500,000 of stock. Option 2, borrow $500,000 at, say, 6% interest, with the stock as collateral. Real rates vary by person, bank, and market conditions. If you sell, the story seems simple until you remember taxes. If your stock went up since you bought it, selling triggers capital gains tax, meaning you owe tax on the profit portion of what you sold. So to net $500,000 after taxes, you might have to sell more than $500,000, which means you now own less stock going forward. If the stock keeps compounding at around 7%, the slice you sold is gone forever. Selling is final. It reduces your future upside and your control. If you borrow, you get the $500,000 without selling the stock. The stock can keep growing while you have the cash, and your cost is the interest, like rent you pay for using someone else's money. At 6% interest, $500,000 costs about $30,000 a year in interest. Again, simplified. If your stock grows about 7%, $10 million grows about $700,000 in a year on paper, while your interest bill is far smaller than that. That gap is why borrowing can look attractive, but it only works if the asset behaves and the loan terms don't turn against you. Taxes are the hidden lever that makes this strategy feel unfair if you've never seen it up close. Capital gains tax only shows up when you realize the gain, meaning you sell and turn the gain into actual cash. Here's a simple metaphor. Unrealized gains are points on a scoreboard. Realized gains are cashing in your chips at the counter. As long as you keep playing and don't cash out, the points can grow without a tax bill attached. A loan is not income, so borrowing against your chips doesn't trigger capital gains tax the way selling does. This leads to the phrase you've probably heard: buy, borrow, die. In its simplest form, it means buy assets that tend to rise, borrow against them to pay for life, and hold them for a very long time. In the US, there's also a rule commonly discussed called the step-up in basis, where heirs may get a reset of the original purchase price for tax purposes when someone dies, which can reduce capital gains tax on decades of appreciation. That's a legal rule, not a loophole you personally control, and it can change with new laws. This is not financial or tax advice, but you should understand the incentive it creates. Selling today can be expensive. Holding and borrowing can delay that bill, sometimes for a lifetime. There's also a control angle that matters for founders and big owners. If you sell a large chunk of your stock, you might lose voting power, dilute your influence, or scare the market by signaling you're exiting. Borrowing lets you keep your position while still getting liquidity. Banks like these deals because they can watch the collateral in real time and set strict rules about how much you can borrow. The wealthier you are and the more stable your assets are, the better your terms usually get, because the bank's risk is lower and the relationship is profitable. Here's the myth versus reality beat. Myth: the rich never pay taxes. Reality: they often pay plenty of taxes, but they manage when taxes happen by controlling timing and structure. Timing matters because a tax paid today is cash that can't stay invested. Structure matters because borrowing and selling are treated differently by the tax code. If you've only ever had wages and a checking account, it can feel like the rules are different, because in practice, they are. Now the part people skip. This can blow up. Imagine your 10 million in stock drops 30% in a bad year, which happens more often than people like to admit. Your collateral just fell to 7 million, but your loan is still 500,000, and the bank may demand more collateral or partial repayment to keep the loan within its limits. That demand is a margin call, and if you can't meet it, the lender can sell your assets for you at the worst possible time. Add rising interest rates, because many of these loans have variable rates, and suddenly your rent for money jumps while your assets are falling. There are also quieter risks that don't make headlines. If your wealth is concentrated in one stock, like your company, your loan is tied to the same single point of failure as your job and your identity. Borrowing can also hide overspending, because it feels like you're living off wealth when you're really increasing obligations. Lifestyle inflation is easy when you can swipe a loan instead of selling something. Debt used offensively still has to be paid, and it gets dangerous when it stops being a choice. So, what can regular people realistically take from this without pretending you're a billionaire? First, understand the borrow versus sell decision anytime you have an appreciating asset, including a home or a long-term investment account. Second, learn the idea of opportunity cost. Selling an asset means giving up future gains, while borrowing means paying interest and taking risk. Third, treat debt differently depending on what it buys. Debt for a productive asset like a home you can afford, a business with real cash flow, or education with a clear payoff is not the same as debt for consumption. Fourth, if you use tools like a HELOC or a small business line of credit, do it with a plan for repayment and a buffer for rate changes. And fifth, talk to a qualified tax professional or financial planner before copying strategies you saw online, because the details are where people get hurt. Here's the clean summary. Borrowing against assets can let the asset keep growing while you access cash. But you're paying interest and accepting the risk of being forced to sell at a bad time. Taxes change the math because selling can trigger capital gains tax, while borrowing usually doesn't count as income. And the buy, borrow, die idea relies heavily on long holding periods and specific rules like step-up in basis. And the whole strategy is fragile when prices fall, rates rise, or your wealth is concentrated. So the question to sit with is simple. Would you rather pay tax now by selling or pay interest to delay tax? And what could go wrong in your situation? If you want, comment sell or borrow and tell me what asset you're thinking about. And subscribe if you want more explanations that make the rules feel less mysterious.